Howdy everyone, I'm Norman Wildberger, mathematician turned banker. In this video I'm going to tell you all about the reserve bank that we set up at the end of the Long Depression around 1880. This was a very innovative financial structure, one of the very first of its kind, and so it's a chance for me to explain to you what a reserve bank does. Now this is in the context of the Western Cactus Bank, which I had set up. My little bank, Little Cactus Bank, had merged with the Western Hills Transfer and Banking Company. Basically, I bought them out. And we created this Western Cactus Bank, and I'll tell you about that in the context of what was going on with my little bank, which, by the way, had a widespread network of offices when I took it over. It had some established stagecoach routes all across the western area, and it had some interesting partnerships with Eastern banks, so it really allowed me to extend the scope of the banking that I was doing. Now, if we look back in time, historically, banks have been kind of involved in three main activities. First is as a place of deposit, where there's a safe place where people can come and deposit goods, money, precious metals, whatever. Another important traditional role is the long-distance transfer of money to facilitate shipping, merchant activities across wide distances. Banks or entities that playing the role of banks facilitated this movement of money across wide areas. That's an important thing. And that's actually what I was kind of involved in when I took over the Western Cactus Bank. So in this context, bills of exchange are kind of important. These are documents that say that an established, say, merchant house will transfer a certain amount of money by giving this bill to a foreign office. They look at the bill, they say, aha, this is from the home office. It says that we need to give 100 gold coins to whoever is bringing this. Okay, so it's a way of transferring without actually physically moving the money. The other thing that banks, of course, have been doing for a long time is to provide loans at interest. The more conventional fractional reserve banking, which I've been telling you about, which is really the primary activity of modern banks, is actually a relative newcomer to this suite of things that banks do. Okay, the idea that people make deposits to banks, which are really in some sense effectively loans, which the bank then uses to, well, to generate income of its own. This is a relatively modern notion. These three directions of the bank are more historically important. So in 1875, we had set up the Western Cactus Bank, and very briefly, for the next few years, what I was involved in is expanding the operations of this bank. So first of all, we got a fresh injection of cash, mostly due to the Smith brothers and the various friends in Big City where I had moved to with my family at this stage. That was the largest commercial center in the western states area. We refurbished a lot of the district offices, turned them from just little shanties to more solid buildings. We expanded our routes from stagecoaches to railways. We really embraced the modern technology. And interestingly, we partnered up with the National Post to end up delivering mail. Since we had these routes transferring monies around, we said, why not we just consolidate that with a mail service, and we actually made a lot of money on that. So by 1880, the assets of the bank are roughly around $15 million, and income of around $2 million a year, more or less. So that was quite a healthy position, especially since the last decade, most of that had been in depression, and we were just getting out of that long depression that started in 1873 and went up to about 1879. So the major development in 1879 was that we set up the Western Regional Reserve Bank. It's really one of the very first of its kind. And I want to explain what's going on with the Reserve Bank, because ultimately it's actually quite simple. Okay, so it sits in between the various commercial banks in the region. So in that time, the biggest bank was the Big City Bank. Okay, and there was also my little bank, Western Cactus Bank. There was also the United National Bank, and there were a flurry of other smaller banks. Altogether, several dozen banks in the western region. Now, during the Depression, a lot of banks had gone out of business or had been taken over by other banks. So there was a major consolidation and a lot of losses over the years due to the Depression and its effects. So the banking situation was quite, let's say, delicate, because a lot of the people in the area had lost a lot of money due to these various banking fiascos. So there was a lot of pressure on the state governments around there to try to fix the banking structure, to make it safer, to reduce the risks of bank collapses, to ensure that ordinary people didn't lose their life savings, their retirements, their futures, because of basically maybe mismanagement or overextension of the banking system. So to that end, we created the idea of the Regional Reserve Bank, actually the Western Regional Reserve Bank. And the idea was that this was going to be a bank which was essentially run by the commercial banks, but interacted very strongly with the state governments. So it was somehow an intermediary between the commercial banking sector and the state governments. And we had to convince the governments that this was a good idea because we wanted them to fund the whole thing. Okay, that was the critical point. We wanted the governments to fund this regional reserve bank, and we wanted them to think about it as almost an arm or an extension of the government, while in reality it was really an extension of the commercial banks. Okay, it was a way for us to consolidate and strengthen our financial positions. So that's what we aimed to do. We had to figure out, well, what's this Reserve Bank going to be doing? What are the various regulations that are going to be required for the government to enact to make it happen? And we had to convince primarily the government to fund the whole thing. So that was the challenge, to try to convince the governments to support the creation of this Reserve Bank. So what we did is we got together and we hammered out a proposal, a plan for the construction and the setup and the running of this Reserve Bank. And we laid out these proposals to the government at a special meeting that we had at the Sunset Lodge, which is just outside big city. It's a beautiful place, lovely resort overlooking the Copper River, beautiful sunset vistas, pine trees all around. So we had a 3-day meeting there with a lot of government representatives, and basically we made the case, okay? We had to explain to them what it was that the Reserve Bank was going to do and why this was such a good thing to support. So broadly, the arguments were along the following lines. First of all, it's going to contribute to a more stable banking system. Okay? The idea of stability, the idea of reduced risks, that was really very attractive at the end of this very serious financial contagion that we just had. And we argued that the Reserve Bank will allow the government to more easily supervise and legislate banks, because now all the banks were basically represented by the same entity. So they could pass laws that could be enacted in the context of the Reserve Bank, which would then, that would filter through to the commercial banks. So there was a lot more visibility, a lot more transparency. The government could see more directly just actually what the reserves were of our various banks. And so this was an attractive aspect, that the government now had more control, potentially, over the banking system. Instead of having a lot of these sort of renegade guys, each doing whatever they wanted to, now everything was going to be in a constrained system, and supervision and legislation were going to be much easier to enact. And the Regional Reserve Bank will also provide safekeeping, tax collection, and ultimately loans to the government. So this is going to facilitate things that the government wants to do. Keep money safe. So the treasuries of the state governments can work together with the Reserve Bank, because the Reserve Bank is going to be a really solid, very safe institution. The vaults are going to be the safest places in the entire state. So that's going to be a great sort of safe haven for money. Tax collection is going to be made easier because it can be then made through the commercial banks, then into the Reserve Bank, and then into the state government. So that simplifies a lot of process. And we're going to talk about this crucial aspect that the whole setup allows the possibility of new kinds of loans to the government. I'll talk more about that. I had a lot to do with that. So this is just going to be what the region needs in terms of financial stability and services to drive development and further progress, and hopefully economic good times. Now, to explain how the actual workings of the bank are proposed, a balance sheet is the best starting point. So here is the proposed balance sheet, the initial balance sheet of the Western Regional Reserve Bank. There's going to be assets on this side, there's going to be liabilities on the other side. In some ways, it's a lot simpler than a regular commercial bank because it's only dealing with a relatively small number of players. It's only dealing essentially with the commercial banks on the one side and the state governments on the other side. Okay, so first of all, there's a building. Okay, and we estimated that the building was going to cost about $4 million because we're going to have these massive vaults buried underground in the basements. So it's going to be very expensive, but okay. There's going to be corresponding equity. So we wanted to get the state governments to contribute $3 million out of the $4 million, and the member banks are going to cough up $1 million. So that was our aim, to get that $3 million from the state government. Okay, so that's going to be the equity that's going to balance with the building. Otherwise, initially at least, things are very simple. Each of the member banks is going to place a sizable proportion of their physical reserves in the reserve bank. So the Western Cactus Bank, for example, instead of having to worry about its own vault and its security, it will place most of those reserves, the gold, silver, and the cash that it has saved up. It will deposit most of that into the vault of the reserve bank. It will keep a portion of that for daily activities, okay, but the majority of it will go here into the reserve bank. And so the idea was that the Big City Bank, which is the biggest bank in the area, would have reserves deposited in the banks of, say, $10 million. So that would mean that there's an account over here on the liability side for the Western Regional Reserve Bank's point of view. That is a liability. The Big City Bank has deposited $10 million. That's $10 million that we're sitting over here in the assets under the reserves. The Western Cactus Bank, say $2 million. The United National Bank, $6 million. And then the other various member banks, corresponding sums. But crucially, these sums over here all get lumped together. They're just put into the vault. Okay, they're all put together. They're not separated. This is all just the collective reserves of the banks. And each bank has then an account with the reserve banks, which reflects the amount of physical cash and coin that it has deposited. That's the initial proposed setup. It's very simple, and you can see very clearly here what the various positions of the member banks are. In particular, the reserve ratios are much easier to calculate because you can see what the reserves essentially are. Right? One of the ideas here is that the government wants to start controlling reserve ratios, to making sure that banks are not too extended, that they don't lend out a lot more than they have. Now, I remind you that, the way the banks really work is that they take the deposits from people, okay, and they put that into their reserves, and then against that they issue loans. Okay, so it's not really that they're, say, keeping 10% of deposits. Rather, what it is that the deposits that come in, okay, into a commercial bank are then the basis for loans. And this reserve ratio caps the amount of loans that the bank is allowed to generate on top of the deposits that they have. Okay? That's the basic model. The monies come in, they are put into the reserves of the bank. That then is the theoretical support for the process of loan creation where the banks actually make their money. So this is all going to be a lot more visible if the government can just come and ask the Reserve Bank, what are the various positions of the banks on any given day. That's the basic setup. So now let's have a look at what actually happens with the day-to-day runnings of the Reserve Bank. So there's various kinds of things that happen, and I want to show you just how it actually works out. So one important thing that this Reserve Bank allows the banks to do is it facilitates transfers between banks. So for example, suppose that the Western Cactus Bank needs to transfer, let's say, $500,000 to, say, the United National Bank. Now, we don't want to actually be physically moving $500,000 around. So what we do is we do it via the Reserve Bank. Okay? So we just let the Reserve Bank know exactly what the deal is, exactly what the terms are, and lawyers are involved and so on to make it all legit. But once we do that, then the Reserve Bank simply does this. It simply changes this 2 million to 1.5 million here. And correspondingly, it changes this 6 million to 6.5 million. The reserves on the asset side have not changed. Okay, that's just all, that money is just sitting in the vault as it did at the beginning of the day. All what's happened is that on the account side, on the ledgers, this $2 million entry is now a $1.5 million entry, and this $6 million entry is now a $6.5 million entry. That's a very efficient way of transferring money. How about allowing short-term loans to banks? So let's say that the government has legislated a reserve ratio of at least 10%. Okay? And suppose that for the Western Cactus Bank, that amounts to having to have $1.7 million in here. So there should be $1.7 million in this account to meet these legal obligations that the state government has imposed on reserve ratios. Okay, so this is no good. We have 1.5, we ought to have 1.7. Okay, we've agreed to that. How can we get 1.7? Well, the Reserve Bank can deal with this. The Reserve Bank can make a loan over here, right? So let's say WCB loan, okay? It's a short-term loan of, let's say, 0.2 million. Okay, so it cooks up an entry over here, and then correspondingly, we can change this entry to 1.7. Okay, now we are in the right range. According to the government legislation, this is now an adequate reserve for the liabilities that we have. And how does the Reserve Bank do this? Okay, it makes this entry, but in banking, all entries have to be supported by something. You can't just make an entry. You have to have some asset that offsets this entry. And typically what happens here is that the Reserve Bank will purchase a note, a promissory note from the Western Cactus Bank. So that's what this thing here is. This loan that I put here is really actually the purchase of a note from the Western Cactus Bank. Now there's a third kind of thing that we might have to think about. What happens in case of an emergency? What if there's a run on the bank? What if there's a run on the Western Cactus Bank and we need to take all of that 1.7 million out because people are clamoring for their money, and maybe in fact we need more, otherwise the bank is going to go under? Well, all right, then there's some capability here, because after all, the Reserve Bank does have a lot of money in their vault. So they can make a deal with us, okay, negotiate something, and we're going to get whatever amounts of money that we require, up to a reasonable amount. We can get that from the Reserve Bank to buttress our defense against a bank run. Okay, so these are three really important things that the Reserve Bank does. It facilitates transfers, it makes short-term loans to banks, basically for them to meet their legal obligations of reserve ratios, and it, in emergency, it can lend money to a bank to help prevent bank runs. Let's talk about promissory notes, which are an explicit kind of contract between a lender and a lendee. So suppose, for example, that the Western Cactus Bank decides to lend $100 to Jack Knowles for a 2-year loan at, say, 10% interest. Then the bank gets from Jack a promissory note, which has the value of $100, that's the principal, plus $10, that's the interest for the first year, and then plus another $11 because that's the cumulative interest on the second year. The principal at that point will be $110, 10% of that will be $11. So altogether, after 2 years, Jack will owe $121. And then he creates something which is essentially legally like this. He writes a note. I, Jack Knowles, promise to pay Western Cactus Bank, or the bearer of this note, $121 on, say, January 4th, 1881, 2 years from whenever we're setting up this loan. Okay. So it's this document then that is part of this exchange. The bank is giving Jack $100 and Jack is giving the bank this note. So it's a little bit different from a loan contract exactly, because it's a piece of paper which embodies the value in itself. In other words, this piece of paper could then be possibly exchanged. The Western Cactus Bank could pass it on to somebody else. And in fact, it makes the entire loan process really more of a sales transaction. We can think about it as the Western Cactus Bank has bought from JK this promissory note for the price of $100. The difference between the $100 that's been handed out and the $121 in promised returns, that's the interest of the bank. So now you can see, how the Reserve Bank actually negotiates a loan from, say, the Western Cactus Bank. Suppose that we wanted to borrow from the Reserve Bank $200,000. What we could do is we could give the bank, say, 2 promissory notes, not for $100, but let's say for $100,000. Suppose we have 2 $100,000 promissory notes, just of this kind, okay, that are currently sitting in our vault. They are assets of the bank. We could then further pass those on to the Reserve Bank, essentially selling them, in some sense, to the Reserve Bank. Now, the Reserve Bank is not going to give us $121 or $121,000. It's going to give us something less. There'll be a discount. Okay, so maybe the bank will give us $115,000 for these 2 notes. Okay, so that's then the asset that the bank gives the central bank or the Reserve Bank as collateral in some sense for the loan, but it's really more of a sales transaction. Okay, the bank is giving these promissory notes, selling the promissory notes, and receiving cash in return. So that makes everything into a sale, which is quite an attractive way for bankers to think. So it turns out that the final sweetener that was really essential to make this all work was the promise of something very tangible for the government. Basically, we dangled in front of them the beautiful carrot of money, okay, in the way of loans. So this is the sweet spot that we can explain, in fact, talked for about an hour and a half, explain to them how we were going to arrange the possibility for the governments to take out loans from the reserves of our Reserve Bank. So, you see, here is the prospective balance sheet for the Reserve Bank, and prominently there's a lot of money sitting here in the reserve. This is actual physical money, gold, silver, and cash, which is sitting in our super secure vault buried under the ground. And it represents, of course, the contributions of 3 banks plus all the other banks. So there's 18 million from just these 3 banks. There's probably another 24 million or something from the other banks. So we had quite a whack of money here. This money is just sitting there. It's not doing anything. It's not being lent out. Okay, any loans that are happening to the member banks are just entries, unless there's a run on a bank, okay, and then we actually have to depart with some money. But generally speaking, the reserves are just sitting here. So a natural thought is, what's wrong with the government, say, borrowing some of that? Could that be possible? Well, yes, it is possible. So what we proposed is that we would allow the following thing to happen. Okay, so we make a government loan over here. Government loan. Let's say the government wants, $3 million for some worthy project. So we write this loan here, and of course we are going to send $3 million to the government. So let's say we'll reduce this 18 million to 15 million plus, okay. So the total amount of assets here hasn't changed. Instead of having 18 million plus, we have 15 million plus this government loan. Now, what's the nature of this government loan? Well, it's another promissory note, okay? So another way of thinking about this is a promissory note from the government, otherwise known as a bond, okay? So usually governments issue bonds to citizens, but in this case, we were promoting the idea that the government could actually issue a special bond to the Reserve Bank. And the Reserve Bank could buy this bond and pay for it with hard cash or coin that the government can then get its hands on and spend it how it wants on no doubt worthy and developing projects. So this is all great, except that it throws into question a fundamental premise on which the entire Reserve Bank is built. Namely, that these reserves here should act as an anchor to the liabilities of the member bank. Now, if we reduce this 18 million to 15 million, then obviously the actual number of real reserves that the banks have has been diminished. And so the actual positions of the banks has been financially weakened, which is kind of obviously against the spirit of the entire enterprise. So how do we overcome that seeming hurdle? Well, what we do is we do something clever. We say, look, government, you are stable, you're secure, you're full of smart, motivated, sensible people. You in charge of states where there's lots of people coming in, there's development happening. Now that the depression's over, things are going to be moving up, and the future looks reasonably rosy. So a bond from you is not just any old loan. If we can take this loan document, this promissory note of the government, and move it from this position to this position, okay? We move it down here, so it's now in the reserves. Then we can say to the member banks, aha, wait a minute, you've got 15 million here, plus this government bond worth 3 million. The total number of reserves that you have is still the same. And how do we allow this? I mean, how is it possible for the reserves to suddenly allow government bonds to be included? Well, I remind you, it's the government in the first place that is legislating the entire setup here. So in the Western Reserve Bank Act of 1879, which we got the government to pass, okay, part of it was that it was allowed for the Reserve Bank to take bonds, government-issued bonds by the state governments, and actually treat them as legitimate reserves. So this movement of the loan from here to here was actually approved by legislation of the government. With this mechanism, the monies in the Reserve Bank, at least some portion of them, were then available to the government for loans. Of course, there was interest, We expected this to be repaid some future time with interest. So it was a money-making proposition from the point of view of the Reserve Bank, and it was a great development opportunity for the governments because they had now this new source of cash. So it was all very sweet. They bought this hook, line, and sinker. They said, yep, we will support the building of the Reserve Bank. And that's what we got. We got an act. We got a beautiful building. It's still there today. You can still go see it. It's still the most impressive building, I think, in Big City. And I was voted to be the governor of this thing. So I served 2 terms as the governor of the Western Region Reserve Bank. So that was very interesting times. Now, the key point here that we've sort of entered into is the magical world of bonds. And we really need to say a lot more about bonds. And to do that, we'll go back in time to the very foundations of debt in modern civilizations and trace the story of debt and bond creation into modern times. That's what I'll tell you about next time. I'm Norman Wildberger. Thanks for listening.